Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we welcome back David Hunter, who is a contrarian macro strategist with over 4 decades of experience within the financial markets. How are you today, David?
I'm great, Karem. How are you?
I'm doing well, thank you. Let's start by talking about gold and silver. In your view, David, are gold and silver now perhaps in a longer consolidation period, or are we still on track for much higher gold and silver prices over the next 6 months? You've made some great calls this year, not only in the direction of the metals, but for the general markets too. So is the environment for higher gold and silver prices still in place?
Yes, it is. I'm probably one of the more bullish analysts on the street for both gold and silver. I think we are just completing a 2-month, a little more than 2-month consolidation. Gold ran up from 1280 to 1560 between Memorial Day and Labor Day, and so it was not unexpected to have it consolidate that gain, and that's what I think we've done in the last 2+ months. I suspect we're either through that consolidation and just coming out of it, or just beginning to turn the corner, or have very little left to go. So I still expect the rally into the end of the year and certainly into the first part of next year. My target, which had been 1550, 1600, which we hit, just after Labor Day, that had been a long-held target for a couple of years or more, and I, on the way up to that, changed my target and raised it up to 1800. So that's where I stand right now, is looking for 1800 on gold. Still have a target of 26 on silver, and I think silver will pretty much track gold in terms of the timing. So I'm obviously very bullish here, and I think gold, will be one of the gold and the miners will be, among the better performers going forward.
So what's your view on everything that's been going on within the repo market, David? This is a new development since our previous interview. So are these the actions of a desperate Fed to you?
Yeah, I wouldn't say desperate, but what I would say is that it's very much a signal that the Fed was too tight for much of this year. And as you know, I made that case throughout this year that the Fed was behind the curve and needed to ease up not only on interest rates but also in terms of QE. And I think what we're seeing here with the repo situation is they don't call it QE. They seem to really be adamant about not wanting to reverse themselves on QE. They've been talking about wanting to shrink the balance sheet and have shrunk it over $600 billion over the last couple of years. So I think they're still reluctant to want to make the case that it's time to go the other way. I'm not sure whether they're worried about how the street might respond or just it flies in the face of what they really believe they should be doing. But either way, this is definitely expanding the balance sheet, the Fed's balance sheet, and it's definitely pumping liquidity back into the system. So you can call it what you want. You can just say it's a repo adjustment, or you can call it QE, but I do think it is pretty much one and the same. I think they differentiated in that it is, they're responding to the needs of the banking system. So I think that is emblematic of the fact that they were too tight. But ultimately, money into the system is going to be positive for the market. And I suspect before this is done, they'll be adding to this and probably calling it QE at some point. Maybe they'll differentiate this piece from what they do going forward. But I still say they're behind the curve, still need to ease more. And that seems funny when rates are as low as they are. But never in the history of the Fed have we, we've never had a Fed balance sheet this large, but we also never have reduced the balance sheet by $600 billion. Any reductions in the past were from much smaller sizes of a balance sheet, but it was also much smaller numbers. So we're kind of in uncharted territory in terms of what happens when you pull 600 billion out of the system, and I think we're seeing exactly what's happened. We're having an economy that's slowing down, moving towards recession. We have a banking system that, despite low interest rates, is requiring higher, pumping up of reserves, and it may also be somewhat global in terms of we're not sure exactly where that, where the liquidity issues are that is causing this jump, 250 billion increase in repo money. It could be that that's somewhat a European bank situation as well. So it's a little hard to get an answer on any of this, but I do believe it's a sign that we're beginning to reliquify the system here. Whether it's going to be sustained or not, we'll see.
Okay, let's move on and talk perhaps a little bit about technical analysis. I know you're a big picture macro investor, but do charts help guide you in perhaps seeking out the bottom of a sector or a market? Or is there too much of a danger of only seeing what you want to see within a chart?
Yeah, as I like to say, the technical analysis is a part of my toolbox. I do use charts. I do look at charts. I probably look at them a little differently than a lot of people in that I like to step back and look at longer charts and kind of to put things in perspective. I'm definitely not an Elliott waver. I am not somebody that gets too caught up in the very short-term charting, but I do feel that picture is worth a thousand words. So I do use charts to kind of give me a perspective of where we are and what are the trends and what has developed over the last weeks and months. But it's in context with fundamental analysis, sentiment, macro analysis, and basically what I try to look at it in terms of what do I think is discounted now and what do I think needs to be discounted going forward. So, unlike a lot of people, I'm afraid, in this business who are kind of caught in the present tense of what's going on, it's important to, as Wayne Gretzky used to say, skate to where the puck is going, not to where it has been. So, that's all part of it. But technical analysis is definitely a piece of that.
Fantastic. Okay, let's move on and talk about a few other markets. It feels as though many investors have been surprised by the weakness in the copper price throughout most of this year. So how do you see the copper market, David? What's your view of that?
Yeah, copper, I've not been surprised. I had a fairly pessimistic view of the economy this year, as you know, and copper is very much tied to the global economy and housing, which has been slowing. So I wasn't really surprised in my forecast. Ultimately, in the coming bust, is that we'll see copper down to $1. The fact that it's kind of lagged here and been under some pressure is not a surprise. You are seeing it come to life a little bit in recent weeks, kind of combined with what you're seeing in all kind of the industrial cyclical areas in the market anyway. It may lift its head a bit here, but again, I still have a forecast of a global bust sometime next year. So I don't think it's not off to the races in a new cycle or anything like that. But it has room. It's been under pressure, so it has room to bounce and move up here a little bit. But ultimately, I'm not surprised that it's been one of the laggards.
Now we're heading towards the end of 2019. So has there been anything that surprised you in the markets this year, David? Has there anything that's caught you off guard?
Not really. I would say probably if people who follow me on Twitter or wherever know me, I tend to be, I will talk about, I don't say will, I say could, in terms of things happening. And, my gold silver call has been pretty much right on. The stock market has been moving up. I've been probably as bullish as anybody on the street, maybe the biggest bull on the street this year for the stock market. and I thought we might even see the full play out of the melt up that I'm talking about play out by the end of this year. So if anything, it's probably lagged a little bit, taken a little longer, but it's certainly been in the context of a rally that's been superb and has defied most of the skeptics on the street. I mean, most of the street's been skeptical of this rally. They've been looking at a slow economy and so, expecting the economy the stock market not to do well. Obviously, I have a target of 4,000 on the S&P. I don't think the melt up has even started, and that's the other thing. A lot of people are using the term melt up, I think, inappropriately. What we've had has been obviously a 30% rally this year in the market. It's been, great, but we have not seen the kind of parabolic move in the market that I think will define what's coming following. We may get a little bit of a pullback and then a melt up, but ultimately you're going to see something that moves very quickly up to that 4,000 level, and it will be kind of that FOMO, fear of being left behind type of mentality will creep into the street at some point. So I think we're pretty much on schedule. It's just taking, a few more months than I might have expected.
As we begin to wrap up, David, is there anything else you'd like to share with us today? And how can people reach out to you if they want to follow your work?
Sure. Probably talk about the bond market a little bit here. Bonds obviously have had a nice run, and I think since the last time we talked, it had run up to, we got the 10-year down to 140-ish, and it's backed up to 195. I think you're going to see very shortly, it might get as high as 2%, but I don't think we're going much higher than that. I think you're going to see another leg up in the bond market, another leg down in rates. So probably see rates down below that 140 towards 1%. Ultimately next year in the bust, I have a forecast of the 10-year going below 0.5%. And the 30-year going below a 1% number. I actually think you're going to see dramatically, or quite significantly below those numbers. So you might see the 10-year down to 0.25%, and the 30-year down towards 0.5%. So ultimately, in the bust, I think Treasuries are going to be the asset to own. That's where people are going to run to safety. So that I would say is probably something here where we've had quite a sell-off, quite a correction back up in rates. I'd take advantage of that here and say that even though I'm looking for a big run-up in the stock market here in the next 2 or 3 months, I think bonds are still probably near a low in terms of this correction, and we'll have another leg up. Maybe coincidentally with the market, or maybe they'll kind of alternate stair steps in the process. But ultimately, I think you'll see over the course of the next 3 months lower rates, and maybe significantly lower rates, and significantly higher stocks. So that's what I would say. And the other big one, I think the dollar is about to roll over. I've been calling for a rollover in the dollar for a while. It's started to turn down, but just been very, very stubborn in rolling over. And I think that's not far ahead of us. And I continue to say that the dollar could drop 10% against most of the other currencies.
And people can reach out to you on Twitter. I know you post a lot of updates there.
Yeah, that's probably the place where you can get the most up-to-date current thinking. I'm not on there every day, but I'm on there quite often, and mostly my market calls, my macro calls. So you can reach me at Dave H. Contrarian is my handle.
Excellent. Okay, many thanks once again for your time today, David. It's always a pleasure having you on the show, and let's catch up again next year.
Sounds great. Okay, thanks, Graham.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?